Welcome to the Credit Clubhouse, where we take a weekly dive into the world of credit markets, alternative finance, and everything in between. Don't forget to follow the show, rate us, write a review, and share with friends. We're always open to guest or show ideas, so please feel free to reach out anytime. Just todd.anderson@dealcatalyst.io. I encourage you to check out the remainder of Deal Catalyst's 2026 calendar, including ABF 2026, Fund Finance West moving to Vegas for the first time, and GPLP Secondaries, which is a new addition to the schedule. Listeners can get up to 10% off any ticket to any conference by using the promo code CREDIT at checkout. And now, on to our next episode. This episode is brought to you by Cardo AI, the operating system for asset-based finance and private credit. These markets still run on spreadsheets and siloed systems. Cardo AI brings everything into one system: the data, the structuring, the borrowing bases and waterfalls, the cash flow modeling and simulations, and the investor reporting. That's front office to back office, all in one place. Today, more than 700 facilities and $150 billion run on Cardo AI. The world's most sophisticated investors and lenders use Cardo AI, equipping their teams with a level of control and intelligence that legacy tools simply cannot match. See it for yourself. Talk to the experts at cardoai.com. Welcome back to the latest episode of the Credit Clubhouse podcast. As always, I'm your host, Todd Anderson, head of content and programming at Deal Catalyst. Joining me today is Altin Kadareja, co-founder and CEO of Cardo AI. Altin, great to see you again. Thank you very much for joining me and looking forward to our conversation.
Thanks for the invitation, Todd. Glad to be here.
So, if we think about kind of your path, a bit unusual into structured credit, founding an AI company, obviously the roots in Europe and expanding to the US. Ultimately, how did that journey shape to, kind of the way you see this industry today?
Yeah, sure. So, Todd, I spent the first part of my career on the buy side of the market and mostly on the risk modeling and risk management in credit. So I had a great chance of working at an insurance company, Allianz, in the beginning, and then for a commercial bank, looking at credit management from bank lines. And then I evolved into a risk modeler with a consulting company and finally at BlackRock. So I saw the market myself from different angles. And I didn't come to this as a software developer or as a software person, but more so as a credit person who really lacked the tools to carry out the job. So most of my ideas on how to change the way I was working came from the frustration that a lot of billions of euros, honestly, were being managed using spreadsheets, Word documents, PDFs. And mostly, I would say 90% of my time was spent cleaning, managing data, finding errors, and only 10% was spent on taking decisions. So I really wanted to reverse this ratio. I didn't think of myself as spending most of my time into spreadsheet, but more so into creating new ideas and investing better the money that I was trusted with.
Was there any specific moment, was it a deal that you're working on and it's like, oh my God, again, I'm dealing with these spreadsheets, or was it just kind of that culmination of there has to be a better way? I mean, we can't just be on Excel spreadsheets forever.
Well, as you probably know, Todd, every deal is different. Data types are different, waterfalls are different, definitions are different. So I would say it's a very interesting space. Every deal teaches you something, so you learn something. So from a creativity and learning perspective, is amazing. But when it comes to the operation hurdles and to the manual task, that is all the same. So the specific moment was, this thing will never gonna change if I don't do anything about it. So I wanted to do it for myself first, And then the aha moment was, what if I do it for the whole world?
Obviously, starting a company, it takes guts. You got to take a jump, so to speak. And every startup has kind of these moments. Do they fail? Do they kind of give up? What was kind of some of those hard stretches that you dealt with in the early days, and what kind of gave you the thinking or the feeling like, hey, we're onto something here? What was there a moment there that also kind of made you think, hey, this we have some legs here to what we're building?
Sure. So the hardest stretch actually was, I would say, the classical technology for finance problems. So a lot of people we serve and our buyers are very sophisticated and conservative people. So basically, thought you're asking a credit team to trust the software you have built with everything they care the most, which is data, numbers, and practically their intelligence. So
Yeah.
we were stubborn into saying that this will transform your life, but not taking a lot of care about how that would be really reflected in practice for their daily life activities. So in the beginning, it was very hard for us to understand that there was a need for adoption and change management. And that happened as we grew and as we saw a lot of use cases. And sometimes in the beginning, we were also too many things to too many people because we also wanted to make happy everyone, as you can
Yeah.
understand,
Yeah.
startup perspective. But then we changed that and focused very much towards what we think we do extremely well and focus only on one vertical, which is the asset-based finance. So when it comes to data standardization, management, normalization, validation, when it comes to cash flow modeling, transaction, and waterfall management, all of those things are things in the last 7, 8 years we have perfected to allow then institutional usage to then progress their product roadmap and not just invent things in isolation. So for us, we had, I would say, two inflection points. So the first one was the trust we got from our first backers, Vazenara Capital in Europe. They gave us a real demanding use case client that has a lot of operational challenges operating in all the world. And the second one was the US expansion. So in 2024, I had the chance to meet with the Blackstone credit and insurance team, and they showed to me a big challenge they had in managing direct lending CLOs and ABF deals. And they chose us, so that was a real validation for us to launch in the US market. And when this type of people believe in you, instead of building anything in-house, because they are the biggest managers, so they can really do that, then
Yeah.
you can see that the problem is real and the solution they need is not something they could do in-house. So yeah, those are two main points of inflection, I'd say.
For those who might not know exactly who you guys are, maybe just give us a good level set. Where are you guys today? Practically speaking, who is Cardo AI, and where do you guys sit within the market? I know we've touched on it a little bit, but maybe just give a full, clear picture for those who might not be as familiar.
Sure. So Cardo AI today is an end-to-end operating system for asset-based finance and private credit investment strategies. So practically, we sit between who originates the loans, so banks, lenders, servicers, and who funds those loans, which are asset managers, insurers, and asset owners. And then we manage the full life cycle of those investments with one single data source and one modeling engine. So you don't need to go and use either siloed solutions or other legacy systems. So again, in more practical terms, what that means is first and foremost the ingestion of data that come from messy loan data files and from dozens of originators and servicers, standardization and validation of those data, and then running everything that used to be run in spreadsheets across the eligibility criteria, the waterfall calculation, the borrowing-based calculation, the cash flow forecasting, the simulation of what would happen if in a certain instance within one deal or at a portfolio level, all happening in one technology. And today the platform runs more than 700 deals, 150 billion in assets under technology, as we call it, and a lot of large asset managers and insurance funds are using this technology, like Blackstone, Liberty Mutual Investments, Neuberger Merman, Oaktree Capital. And what we're really building in a nutshell, Todd, is the operating leverage that the market needs to be able to scale faster and actually not be limited by what the deal team could produce, because this was one of my biggest problem I had at BlackRock when I started the company, because every time I wanted to change something, it took the tech team 9 months or 1 year to do that for me. So if I would invest, for example, in a new asset class, probably the deal was already over when the tech would be ready. So that thing, you need to have a really flexible data model to be able to accommodate the new asset classes and new structures that are coming in. And that's what we have built with this technology.
Yeah, so if we look at the buy side, obviously it's a place where you used to sit. How have you seen it, the growth of insurance interest in this space? Why have you seen some of that growth? And do you think a little added piece to that, do you think a tool like this also helps the insurance investor when looking at, whether it be ABF, fund finance, direct lending, whatnot?
Absolutely. I think if I need to choose one word or one reason why insurance capital has been growing interest into the private credit and ABF space, it comes down to duration. So a life insurer or an annuity writer has long liabilities, 10, 20, 30 years.
Yeah.
And public investment grade spreads have been historically very tight. So they need to have assets that match long liabilities, but also pick up incremental yield that is needed, but without having equity-like risk, obviously. And asset-based finance is really tailored to that. It is largely investment grade, secured by real cash flow collateral, and it offers a liquidity and complexity premium because it's harder to access and operate. So for those specific reasons, the insurance market sees a very good target for their objectives at the ABF space. And it shows also in numbers. McKinsey estimates the insurance-linked platforms up 50% from 2021. And the Nike reports US life insurance allocation to private credit was up 80% in 2025. So these are all new data that gives us the confidence that who are the new investors that have an interest into this type of asset class that is really financing the real economy. And
Yeah.
do we have a replacement of banks with insurance? I don't know about that. Maybe we can explore in the following conversation. But it's an interesting point of view to see how regulators push after the financial crisis and how the market evolution brings up new ways of operating and brings up new pools of capital as these needs emerge.
If we think about the GP, what would you say are some of the biggest gaps from GPs looking to raise insurance capital for the first time?
Well, I wouldn't say just one because, insurance capital comes up with a regulator and actuary attached to it, meaning a GP that used to raise capital from endowments or pensions now need to speak a different language. So it's a Nike risk-based capital language. It's a principle-based bond definition that is not anymore like what is for endowments and pensions. So, and insurance will not take the word that this is an asset and is classified as a bond just because you say so, but you need to follow a specific regulatory defined definition. And also, for example, they need specific structures. A couple of them are like the rated note feeders or the rated CLO private credit structures or the collateralized fund obligations. All of those are structures that insurers are very familiar with, but that you as a manager need to be able to manage continuously because they are very, very complex. And the last thing you want is to not be able to manage a structure that you have raised capital on. The second gap, I think, is has to do with operational data readiness. So insurance and their auditors actually need loan level data. They need to be able to run scenarios independently on demand. So the practical and operational structure is really complex. So you need to be able to provide to that. The quarterly PDFs, unfortunately, is not enough anymore. So people need to equip themselves with either technology or analysts or people that can really help with these operational hurdles. And I would say one of the bigger reasons why we exist is because of that, because the big investors and, let's say, regulated investors need to have validated granular data in order to run their own stress tests on top of the underlying loans that these structures have been rated or that have been structured for their regulatory capital requirements. Yeah.
Do you think we're moving? Obviously, traditional reporting is kind of a thing of the past, or getting to become a thing of the past. I think we're moving to a point where, I don't know if I'll say real time, but fairly close to real time reporting. Like, it feels like the industry's moving fast, capital's moving fast, and now you need tools to equal that speed and that report on that type of speed. And that's kind of where you guys are starting to
Yeah.
fit in, so people can then make decisions daily or weekly or monthly versus quarterly or biannually. Am I reading that correctly?
Yeah, absolutely, Todd. There are a few large asset managers that are moving towards that, and we are helping exactly that type of framework. Just one step back, traditional frameworks were built for a world of liquid, rated, standardized bonds and QSIP type of
That's
statements
true.
that you are used to. Today, the insurers, but also other type of complex investors book do not look anymore as vanilla as it used to look at. Now they hold private ABS, they hold forward flows, they hold equipment leases, fund finance, and all of those structures and asset classes have different complexities and have different risk underhidden within those structures, but also opportunities, right? So when the portfolio is that granular and that structured, having only a backward-looking quarterly summary, I would say, is really dangerous. So you really need to look through to the underlying loans, the capability to really see the concentrations and also the payment in kinds that are building up recently, run forward scenarios, what would happen to my cash flows in case, the capital charges if unemployment rates change in a certain way or rise, 200 basis points or prepayment slow down. So you need to equip yourself with all these tools in order to guide your investment strategies and your decisions, because you cannot really look and wait for the end of the month to see what's happening with your portfolio and only then take a decision, because then it's really too late. And I would say that regulators really do agree with this, because the last report that I read from the U.S. Treasury, they organized with insurance regulators. They all came together to a common definition that portfolio transparency should be a key theme for 2026. And as you alluded to, Todd, the market is moving from obviously a periodic reporting to a continuous, hopefully daily report. It came also from a push, as you have seen in the market, on accessing more the wealth channel and the redemption pressure that these funds have
Yeah.
had. And obviously, you need to know what's going on with your funds, not anymore at a monthly, but at a daily or even real-time basis. So the connection with the bank accounts, the connection with the liquidity providers, and all those information coming in one space where you could really take a decision on what to do and how to manage your portfolio.
You referenced it a little bit earlier, when we were discussing kind of the insurance piece. The banks have kind of retreated, or at least have adjusted their positioning into where they sit. Part of that is obviously regulatory post GFC, but I think there's kind of been a kind of a balancing, or at least a shifting in the structure of the markets. curious what your thoughts are on kind of as insurance capital has increased, banks have kind of retreated a little bit. Are we kind of in a new structural dynamic? If regulatory, pressures ease a bit, do banks kind of go back up, or do you think we're in a different state today than say pre GFC or even post GFC that those first couple of years?
Yeah, I mean, after the financial crisis, banks took a stance of, from an originate and hold business model to an originate and distribute
Yeah.
or sale business model, and trying to find as many partnerships as possible, given, the limits that the liquidity and capital rules have put towards them. And we have seen this in Europe quite early because Basel III was applied many years ago, and the Basel III endgame, the new proposed rules are a little bit more relaxed, so that's good for the U.S. economy. However, I would say that the market during all this time has really shifted, right? So roughly 200,000 U.S. companies have had finance by non-banks, and that
Yeah.
is probably 1/3 of private sector GDP. The same story holds true in the UK. So we have 15% of corporate debt, which has been done by non-bank sponsors. And that's real economy footprint. So this is not a niche, it's a structural shift. And I think the future, however, I think is going to be hybrid, right? So you don't have one or the other. I think banks and private credit will be partners, banks originating and providing leverage to those funds,
Yeah.
but private capital firms will hold the risk. And the reason is a little bit what we saw with Silicon Valley Bank, because a bank typically is long assets. As you know, they are illiquid and long dated. You have loans and mortgages, 5 years plus, and they are short liabilities because they have deposits that could go out in
Yeah.
24 hours. So this mismatch of assets and liabilities pushes that model to be more as an originating or client facing, and also providing senior leverage and having more private credit shops to be the risk takers and risk analyzers.
If we think about, ABF today, you have consumer, specialty finance, equipment, infrastructure, royalties, data centers, so on. Is there kind of any area within the market you're seeing the most innovation, the most momentum today?
Yeah, I would say all of those asset classes are growing quite good and very, very fast. But the energy, if I have to pick a few of them, is mostly concentrated on the digital infrastructure space, the data centers, the whole AI CapEx wave that needs enormous long-dated capital, as you know. But also the specialty consumer finance, like the buy now, pay later, the point of sale. It has to do with the user experience, right? People are evolving. People want to take and buy and pay very quickly. So hence the payment rails and also the credit structures need to be in a way that can accommodate these kind of needs. But also equipment finance and fund finance are maturing fast. The esoterics, like royalties on music rights, litigation finance, are also growing. So I'm very excited for all of the asset classes, specifically on the digital infrastructure, which I think is going to keep on growing in the next 2 or 3 years.
Thinking about your tool for these, asset classes, is there any that it doesn't, or it's too niche or too esoteric to apply to, or does it fit, kind of any asset class? Because I'm trying to think if there's like something weird or
Yeah.
funky, and it's like, oh, this would fit outside the technology, but is the technology built to fit the asset class?
Yeah, so the answer is all the esoterics can fit. That doesn't mean that we have all the asset classes in the platform yet, Todd, because
Yeah.
as I said in the beginning, the way we have built the technology is with the right flexibility to accommodate new structures and new ideas. As we speak, there has been no one single asset class that has been presented to us from some clients that we said no to. And I can promise you that I've seen a lot of esoteric things that are very, very cool. But and the last one, for example, as I mentioned, the music rights. So we connected with Spotify's subscription data to predict future revenues of that album, because those were
Pretty cool.
the underlying collateral, the rights to that album. And that is just one case, one alternative data that needs to be fed to that asset class in order to predict the future cash flows and take decision upon that, on the covenant design, on eligibility criteria, on the borrowing base and forward flow structures, all of those included by that data stream. And then who knows what's coming next, right? And I'm curious to see, what these deal teams will invent, because again, as we speak today, this flexibility is the highest, and and even if it's not, I'm gonna do everything I can to make it happen, because the last thing I want is to have 99% in my platform and 0.1% outside of it, or 1% outside of it, and I don't want that. That would be a disaster to my mission.
So if we think about, kind of some of the, different structures and ways that transactions are done, whether it be forward flow, warehouse, asset-backed credit facilities, how does the technology kind of contribute in managing these transactions, and how much more efficient and time saved is it this way versus, say, the traditional way?
Yeah. So all of the structures you mentioned before, so the forward flows, the warehouse, the asset-backed facilities, are all very operational intense. So and that's precisely where software technology like ours and others really give a hand. So if we take, for example, the forward flow agreement, so the originator commits to selling specific loans to an investor on a recurring and revolving basis. Every cohort, which could be weekly, monthly, daily, these loans have to be tested on eligibility criteria. They need to be priced, they need to be funded within the warehouse limits, and then tracked through the waterfall. Done manually, I wouldn't say it's an army, but close, of analysts to reconcile the spreadsheets. And this is only for one deal, right? If you have more than one deal, then and every reconciliation is a chance of error or a missed trigger, right? So we have seen in one case with one of our clients, there was an error of 32 million wrong calculation on a borrowing base. And actually, it was an error. There was no fraud. All the actors were playing along because the rules and the credit agreement was followed in the same way. There was only an error that took this continuously in time and ballooned to 32 million. Now that problem is fixed, but thanks to the technology, you could really track those things because it's a programmatic way of checking. And yeah, so automation, I think, is super important in this work. I don't think the market is acting or playing in a wrong way. Every actor wants to do it well. The problem is that the technologies need to be connected and they need to work to help people not to make errors rather than have and add only people in checking things. So I think the automated workflow will give a big ROI to people. As I said, for one deal, 32 million of ROI, I don't know what kind of value is that, but I would say a big value.
Yeah, we touched on it before. Obviously, some of the noise in the private credit market the last 6 months or so was around valuation of illiquid assets, redemptions. When we think about investors and mark to model pricing, how can technology kind of make that more defensible?
Yeah. So the mark to model pricing is almost unavoidable for illiquid assets. So unfortunately, we don't have a screen price for a pool of private receivables. So the danger, I think, is not the model itself, is the black box. So it's evaluation is only credible as the inputs you could see, you could test, the assumptions that you can interrogate, and the audit trail you can reproduce. And the criticism so far has been always on, can I see the valuation methodology that you have used? Can I really reproduce the same thing that you have done? And I think technology definitely makes it more defensible. And there are a lot of people like us and other providers that are doing a great job here. I would say, first and foremost, the data lineage is super important. So tracing back the valuation methodologies, to the underlying loan data level, but also to the cash flows is extremely important. Consistency and frequency, meaning if you are consistent in time with your methodology and you can show it with live rate curves or with building cash flow engines or anything that people are used to, and they can do it also independently, that gives the trust that people are looking for. And lastly, I would say the scenario transparency is very important. So what has been the scenario that you have used and how coherent you have been with these scenarios in time across different illiquid assets? You cannot change scenarios just because that will produce a better valuation for your needs. And you need to be able to publish that, to provide it to your investors, and to explain the different methodologies and logics behind those applications. And that has to be applied not only at one investor, but across the investor space within the same deal and within different deals in the same segment. So I think if you have technology and if you apply these two or three things, then you can pass from a I don't trust you to I trust you and I'm gonna only verify you in order to allocate more money to you.
So, private credit, asset-based finance growing quite quickly, especially the last five plus years. That has obviously brought the attention of regulators and legislators. Some have said, systemic risk and use words, and some have even warned, is this another 2008? How much of this, from your perspective, as someone who's been on both buy side and now running a technology platform, how much is warranted? And, when we think about the growth has been somewhat in a benign environment, is there any worry from your side if we do hit a real downturn on some of these structures?
Yeah, so it's very curious to see, how different actors in the market play given their incentives and their roles. And here I'm going to quote the governor of Bank of England, Andrew Bailey, right? That mentioned the canary in the coal mine after First Brands and Tricolor. But again, I mean, I think the words are right. We have to ask questions when a market grows so fast and there is so much interest from very large institutional pools of capital, and every player needs to act on their specific role. I think that the evidence shows the contrary, meaning there is not at all a systemic risk. And I think Fed's position in June 2025, after they concluded their stress test, was that private credit and hedge funds in the specific exposure to ABF and private credit was not a systemic threat to US banks. And I think, however, the structural reason that this type of instruments need more transparency, they need more capability of looking at the same data and reasoning in a standardized way, that brings a lot of interest from every actor. And I think that is a good thing for the market. I saw also the stress testing exercise that the Bank of England proposed actually a couple of days ago. And it is very, very severe, even more severe than the banks themselves, which is very surprising, I would say. And it's interesting to see, how these funds will behave and how the exercise will go. Obviously, having banks more exposure to private credit, hence the central banks get more involved. But getting to your question, Todd, my honest answer is that I think idiosyncratic credit losses and fraud, yes, those are real, and we will see a lot of them, and people need to be very, very careful. But a banking system systematic threat or a 2008 style cascade, I think it's very less likely, because the funding structure is fundamentally very different. And I'll just also mention the incentive scheme and motivational layers that are built within private credit shops are very different. Now, a lot of asset managers have incentives directly connected to the deal-making teams. And I think the more you connect the incentives of carry and interest and bonus pools to the team that has underwritten the deal, the more careful and the better equipped those deals will be, compared to if you are not at all connecting your incentive and remuneration scheme towards the person who is actually operating that deal, especially when you don't have a shared technology or a shared risk system, like what happens typically on the private credit side. So I think the market is looking quite strong as we speak. Of course, the default will grow, and we saw a couple of indexes get higher at 2.73%, I think, in Q1 this year, and it was higher than in last 2 quarters. And that's a normal evolution of market, I would say. But I don't see a systemic risk.
And we're also, to our point earlier, it's not, everything's not concentrated with banks anymore. It's more spread out than
Absolutely.
2008. I know it's insurers obviously are still very much, and large corporations, and they hold a lot on their balance sheets. But in terms of the risk is certainly a lot more spread today, than it used to be, which was obviously very concentrated within the banking sector. Just in terms of do you think bubble, no bubble, and do you think the fact that we've grown in kind of a more benign environment, and rates obviously have gone up since, do you think that has kind of truly been tested just yet?
Yeah, I'd actually separate the asset class from the behavior itself, Todd. So the
Okay.
asset class, I don't think it's a bubble. It's a genuine structural reason why banks retreated, as we mentioned before, and why non-banks stepped in. And the demand from insurance, for the long-dated secured investment grade asset, as we just mentioned before. What can get a little bit bubbly is the behavior at the margin, right? So when you have too much capital chasing too few good assets,
Yeah.
that compresses spreads, that erodes covenants, the lending standards go south, and it pushes manager into even more exoteric kind of collateral to hit return targets. And we have seen that move in other markets, like we see the AUM projected for the private credit to become 4.5 trillion by 2030. And the risk obviously isn't the whole thing that pops up. It's the cohort of a weaker manager who run the road loosely in easy years that gets exposed when the cycle turns. So I wouldn't say the bubble is a wrong frame. The dispersion is the right one. We'd see a big gap between the best and the worst operators, and this will widen enormously as we go forward. And it will come down to the underwriting discipline and the speed you needed to push your team to underwrite, and the quality, obviously, of the data and the operations, because at the end of the day, the risk is hidden in the data, and the data should be tracked correctly.
I want to move a little bit back to the technology, and then touch on AI before we have some fun at the end. Obviously, we've been talking about asset-based finance or direct lending kind of individually, but a lot of these asset managers manage a lot of these different strategies, direct lending, ABF, CLOs, everything kind of simultaneously. What operational challenges does that bring, and how is technology starting to solve some of that?
Yeah, I mean, when it comes to, I would say, technology and AI use cases in our space, I think a lot of tangible wins as we speak today, Todd, are around the boring ones, meaning extracting and turning unstructured data into reasonable data that we could use to really take decisions and see more clearly in what is happening with the structures and with the investments. And that is tangible today. That is really good, is becoming even better, and it's very, very fast. So from the time it takes to take a credit agreement of 400 pages, connected with the data tape, reading a service report, extracting covenants from a side letter, connecting it with again, loan tape and cash flows, defining well the terms of the structured model and the waterfall. That is really not a science fiction anymore. It's in production. So We have done it. I think also others have done it. So it's there to be used, and a lot of our clients are using it. I think another tangible application is regarding the monitoring and the early warning. What that means, Todd, is that instead of having a team of people going and checking covenants every day, every week, trying to collect data manually to compile those covenants, you have a system that already automatically takes those data in, but then you have machine learning models to spot on different patterns that before this analyst didn't see, or that somehow could happen in the future, maybe in the next 6 months or 1 year, and you should act now. Like either with renegotiating the contract, inserting a new covenant, restricting some activities that could not make that risk come true just before the real risk is happening. So those are all real. Those are all tangible applications that people are doing it today. So I think I'm very, very excited when I see AI applied in our market. Obviously, there has to be a lot of governance, a lot of time spent on where and how to use specific models for what you need. But those two use cases are real cases that we are applying today.
Where is the line, like when it comes to AI, of like you said, I think you gave a perfect example and perfect use case. It can help identify a problem before it's a problem. You can act today and hopefully set up a transaction or a deal that can then smooth out an issue or change an issue entirely before a real problem comes. But
Yeah.
where is that balance of like what should be machine, what should be human, like because I'm assuming that we're starting to get a little bit blurry and
Yeah.
some of the origination or other decisions are going to start being tested by AI. And what does that look like?
Yeah, that's a great question, Todd. I think everything that is manual and boring should be machines taking charge of. So, so I mean, think about it, Todd. We were not born to do repetitive tasks. We are not ghosts for that. Even if we excel at that, that doesn't mean that people and humans were born for it. We were born to judge, take decision, be creative, move the things. That's how we thrive. That's what our
Yeah.
brain should be used at. I think that as we stand today, at least 40 or 50% of our industry has an untapped value just because most of the people are used for manual tasks, like I used to be used, right? So again, going back to my mission initially, machines should be used for any manual task, reproducible activities. So data extraction, reconciliation, eligibility testing, covenant tracking, drafting memos, anomaly flagging, all of these are machine heavily assisted or produced by AI. When it comes to what is an alert, how do we design a covenant, what should be the negotiation strategy be, how I should take this deal forward, should I think that the future will be like this or like that, those are all human-like activities. And most importantly, when it comes to the fiduciary duty of any investment managers, that still will remain human, I think. And I think the outcome accountability will remain human. When it comes to then reproducibility and manual task and automation, that is going to be all AI and machine led.
What about, before we get to a couple of, kind of closing questions and some fun questions, what about the data security? Obviously, you have AI, on one side, but then you have AI attacking it. So it's kind of like AI versus AI in data security. Like, where is your level of concern about, where the data sits, how the data maybe can be disguised? So
Yeah.
other, like, it just feels like, at least for me as a non-technologist, that like, can we ever stop data being stolen?
I think so, Todd. I
Okay.
think I think on security, there should be a non-negotiable for institutional client, which is related to clients' data never being used to train any external model. That they don't want to use that for. We should have very strong access controls, encryption, very clear data isolation systems that institutional buyers need to be comfortable with using this technology. And we have spent the last 15 months doing exactly that, because we know how important private data is for private markets. And in some of those data, there is intelligence that clients need to govern, control, and reuse it in the future. And that's the secret sauce that these teams have built in time, and this knowledge should stay with the client. When it comes to governance, you need defined decision boundaries. So we should document the methodologies. We should have always version controls on the models. You should be able to define and decide which model and where the data is in input and output. Everything should be auditable at every point in time. And with a click of a button, you should be able to trace back what has been the usage of that data within the system, both from a software and AI perspective. And again, going back to my roots in Europe, Todd, I mean, as you know, in Europe, we have the AI Act, which is starting to be applied in August, actually. So in a couple of months, you know how much people were frustrated with that act because we were blocking something that we didn't have. But as you know, we learn from these things. So for us, you know, applying that and being compliant with these acts allows us to invest a little bit more aggressively on the governance, just to avoid any type of risk and mitigate any type of situation. I hope the same doesn't happen in the US, to be honest, because I want to see innovation first before blocking it. But
We'll
governance, yeah, I mean that's my invitation to the US. That's not something to copy, but it is a good playground when it comes to very rigid governance systems that can control their models and help clients identify where the data and what kind of models have been used by who and what.
Is there a technology trend in private markets that, people are underestimating today? Obviously, we talked a bit about AI, but is there something else that people might be underestimating today?
Yeah, I would say a lot of people talk, but they underestimate the data standardization thought. So data standardization to me is the most important thing because it's the connection tissue between the logics, the waterfalls, the liabilities, the performance, the different reports that come in time. And people do not point a big interest on, or let's say they don't estimate or overestimate, they don't value so much data standardization. I think that is the backbone of everything we do on top. And if you look at our journey in this 7 years and a half, 8 years, I would say that 80% of our time has been spent in standardizing the data across different collateral and asset types. Everything else you build on top, it's fairly easy and a lot of people can do. But if you have a good standardization model, if you have a golden source of data models across different asset classes, that is key to you to scale up everything else. And as we were talking now, but as everyone in the market is looking at the AI agent, not enough people are looking at the fuel, right? So the clean, standardized, normalized data, it's not a glamorous trend, but it is actually deciding who wins and who loses in the AI race.
What excites you most about kind of the next innovation phase of structured credit, asset-based finance?
Yeah. I would say the most interesting stuff is really being able to connect the whole market with one technology so that the pools of capital coming from very sophisticated investors like the insurance funds, the endowments, the pension, the banks can really flow down in the real economy quite fastly, easily, and in a transparent way. If you'd have asked me, Todd, what is the background of the name? So Cardo is a way that Roman architects used to build old cities when they were conquering a new city. So Cardo was the connection point between the north and the south, and Decumano was the east and the west. Cardo used to be the biggest artery where the whole economic activity was happening in a Roman city. So that's exactly what I want to build, a flowless highway of capital flow between who needs to allocate the money with who gets the money in the fastest ways possible, with the most transparent way, and with the best infrastructure to operate with the highest speed.
So we have just a few minutes left. I always like to ask some fun questions. So do you have a favorite sports team and or hobby?
I'll say football is my favorite sport. But obviously, I'm a European person, so it's big in Europe, and yeah, unfortunately, I support Albania and Italy, but none of them participate in the World Cup. So, so now I'm supporting England. I hope they win the World Cup. But football is my favorite sport.
One surprising thing about yourself.
Oh wow! One surprising thing about myself is that I love surprises, right? So whenever I have a surprise on a daily basis at work, at life, it's something that I'm very keen to spend time with. When I talk to clients and they provide to me a new structure, I get so excited. Or when I talk to friends and they are, looking at something interesting, or we need to do something good together, or spend time together, or see something surprising in a new movie, that's really surprising for me. I know I'm playing with words here, Todd, but it's that you understand. Yeah.
One book that you'd recommend reading.
Oh wow, that's a good one. There is a book from Nassim Taleb called Anti-Fragile. It's a very nice one. It helped me think on how systems can not only survive after stress, but even become better. And it's connected now, Todd, with what I think about humanity, because everybody is afraid that AI will take over and we will be worse off.
Yeah.
I think that if we are stressed at the level that we need to be adapted in a different way, we're going to be better off. So that's why the system is also connected to human. I don't think Nassim has done that in the book, but this is my perspective.
Most exciting part of your job.
Oh, nice. When I get a new client.
Perfect. And then final question, one prediction for the next 12 months.
I mean, in our market, I think dispersion will become the story. Dispersion into who performs well against a higher default environment and a more stress situation. As I was saying before, the Proskyer index hit it 2.73%, if I'm not wrong, in Q1. And the defaults are picking up. So obviously, the better managers will survive and win more mandates. The worst one will be absorbed or will default. We saw, for example, Oaktree Private Credit Fund a couple of days ago, I think, saw the redemption request drop by nearly half in this quarter. That's a very good news because it shows that once you provide the right amount of returns and your expected, and you are providing performance, then people are not worried anymore. So I think dispersion will become the story in the market. Dispersion will divide people that are using the right intelligence the right way, they have the right teams, the right access to the right deals, and also use technology and the right transparency with their investors.
I think that's a good place to leave it. Altin, thank you very much for spending the time. Really, really appreciate it. And thank you for your support of the show. Really appreciate that as well. So thanks again. We'll see you again sometime in the future.
Thanks for having me, Todd.
Yep, of course. Thank you for listening to the Credit Clubhouse podcast. Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.com. Thanks for listening. Until next time.